Okay, what I'm going to be doing here right now, I'm Dave Weiner, and I want to welcome you to coming into our website. And one of the things I'm going to be spending some time today is that for most of you, you have bought a insurance contract as part of your banking, like a bank process. And what I want to do is re-educate you to how that insurance contract works. We're going to educate you behind the scenes on this, and I'm going to pull up an actual actually what I'm going to do is I'm going to go in here and grab an actual illustration of a client that we have done. And as I open this up, we've nicknamed this one Joe Banking Like a Bank. And the objective of this workshop here today is for you to actually behind the scenes understand how the insurance contract works. And it might have been a few months ago since you purchased the product from us. It might have been 2 years ago or 3 years ago. What we're doing right here today in group session is teaching you behind the scenes exactly how to take maximum advantage out of your contract and really understand it, and how it can be of great benefit to you. So I really want to take that time and get that done. Now, by the way, I want to spend some time on the company. National Life has been in business since 1848. They are one of the oldest mutual companies in the United States. And last year in 2022, they were the #1 seller of index life products in America. Moody's and Standard & Poor's, that did financial evaluations of the 1,000+ life insurance companies in the United States, came to the conclusion that only 50 of the 1,000+ life insurance companies had what was called a favorable outlook. 2 of the top 5 insurance companies with favorable outlook were both national life companies, National Life itself and Life of Southwest, a wholly owned subsidiary of the National Life Group. So I wanted to share that. Now, I'm going to be talking about this illustration here. We're going to make our way into this page right here. Now, these numbers right here, when you look at an illustration, this is making the assumption that our client has paid off all their debts, and that all the debt money and excess money and the cost of insurance money was literally going in to this insurance contract. And while most of you did not start at some huge, massive amount of monthly premium, we did figure it out, because the IRS would dictate how much death benefit had to be enforced if you were successful in navigating your program so that all your money could go in that contract. And so the IRS, if you were this individual, they would have told us we had to have $1,363,000 in life insurance amount to put over $80,000 a year into this insurance contract. And this is not our imagination. This is a pretty substantial amount there. Now, I am going to clear our drawings. And the first thing I want to point out is that for most of you, if something was to happen to you and you were to pass on, that is 9 times out of 10 enough money to retire that debt. This is also the new type of life insurance. As I scroll down, you will notice we have the ability to release that death benefit up front in the event something bad happens. Now, in the United States, the average age of a critical illness claim for an insurance product currently is 43 years of age. 2/3 of the bankruptcies in America, folks, is for medical incapacitation. And it's not because of a lack of health insurance or having health insurance. It was because their income stopped. 66%, 2/3, as I said, was a medical incapacitation bankruptcy. The average age of a medical BK in America, according to Harvard Law, was 44 years of age. And so if our client suffered a heart attack, a stroke, or a cancer, some form of critical illness, this is a statistical fact. 7 out of 10 people that suffer one of these events under the age of 65 survive the incident. And while it may cripple them financially to have their income stopped, in this type of insurance contract, whether it's a terminal, chronic, critical, or an injury, or even Alzheimer's, I am able to release the life insurance death benefit up front with no death involved. And you, the consumer, in addition to having that money up front, there was no charge from the insurance company to you to have that benefit. Now, when we designed the contract, I'm going to make our way to page 5. And on page 5, there's all kinds of different choices of interest crediting for this contract. Now, this is an index life contract. We're able to use outside indexes, which means we literally have outside money managers managing those indices to try to get to try to have a successful year. Banks and business owners do not want losses on their balance sheet. They cannot expose their capital reserves to losses. Business owners cannot go in to a bank and borrow against any asset that is considered a tier 3 asset. Tier 3 means it's at risk of money imploding. Now, I'm sure sometime in your life you've had money at risk and you've lost money before. This contract that you own, when I'm done teaching this portion of it, I know that you're going to understand that your money is not exposed to any volatility. Now, the default index of contracts that were issued 2020, late 2022, early 2023, is using the volatility index, the United States Pacesetter. Now, this index is a very big deal to us. It's a good index. I'm going to scroll down and I'm going to clear our drawings. I'm going to work our way into it. And I promise you a couple of key things on this index. In a ability to do what is called a back test over the last 20 years, you're going to see an index that we have no cap, which means unlimited earning potential. It's passing through 130% of the performance, and it's guaranteeing our clients no losses. Now, if you would have been a customer the last 20 years in a back test of those numbers on that volatility index, you would have been delivered a return just picture perfect 8.92%. If we would have had you in the Standard & Poor's 500, and I will explain why it's a different thing here, but this is a cap. It means you get no losses, but you only earn up to 9.25%. And I'll talk about that more in a second. In fact, we're going to make our way down in the ledger to an area that actually looks at the last 20 years. And if you look in your ledgers, this is about page 19, if you have a copy of one of these ledgers that was done by the insurance agent when you bought your contract. Now, on page 19, we're able to look at that back test. And as we look at this back test, and I'm going to make it just a smidgen smaller so it fits on the paper so that we can really take a good gander at it. I'm going to look at the Pacesetter index first. Their money managers are susceptible to losing money just like anybody else. Last year, it was an ugly year. You have to admit that. And they had an ugly year. They lost 15%. But none of our customers that was in that index inside this insurance contract had any of that loss passed on to them. There was no loss. Now, for some of our customers, They were utilizing the index known as the S&P 500. This again was an index that had a very struggling year last year. It lost almost 20%. None of that loss was passed on to our clients. And you know what? You got to admit that in a bad year to get no loss, there's nothing wrong with that. You have to, you got to sit there and go like, that's good. If I go back to 2008, this was only 15 years ago. I know you remember that year. That's the year Lehman Brothers went bankrupt. AIG, the insurance giant, had to be bailed out because they insured all those toxic mortgages and they borrowed over $185 billion. I mean, it was a bad, ugly year. And that year, the S&P 500 lost 38%. If you were our client inside one of these insurance contracts, none of that loss was passed on to you. The volatility index, even though it only lost a 0.5 point that year, that 0.5 point was not passed on to you. So how do they do this and how is it attractive? Well, what happens is, and this is make it extremely simple, you have a choice of a guaranteed return every year. That guaranteed return could be between 2 and 4%. And you decide to trade in the small minuscule guaranteed return and to get all the market ups with none of the losses. And what we do is we take that guaranteed money that you traded in and we buy as an insurance company an actual option. Now, on the volatility index, the options are a lot cheaper than the options on the S&P 500. Because the options cost more on the S&P 500, this is why there's a cap over there. Now, 2 years ago, and who can forget the summer of COVID, the volatility index, while you were sitting at home wondering when you were going to get to go back to work, it delivered a solid 14.75% return. The S&P 500 did better than the volatility guys. They actually delivered 16.26%. But on the volatility index, you had a no cap and you got 130% of their performance. So guess what? Not only did you get the 14.75, it actually ended up being 19.18% credited to your contract. If you'd been in the S&P 500, it did make 16, but you were only credited 9.25. And by the way, that is way better than a money market return. In fact, 8 of the last 10 years for our clients that were in the S&P 500, they made 9.25%, 8 of the last 10 years. And that there's nothing, that is great return. Again, way better than a money market. Now, for today's teaching behind the scenes, because you were put into an insurance contract that was going to emphasize the banking strategy known banking as a bank, which involves a lot of lending of money because you're imitating the institution. I want you to understand as we're doing this recap to get you to understand this insurance contract that the National Association of Insurance Commissioners dictates the amount of profit that you can show by using the banking strategy of lending. And so what's going to happen is when I go in over here to teach it, I'm only going to teach this not at all these big fancy returns. I am going to teach it based on only making a 0.5 point. My burden on a 0.5 point is I have to prove to you that we can overcome the cost of the life insurance and that you earn a substantial profit for that effort. In other words, we have to prove to you that this is the best thing you've ever seen in your life. And that is not some easy task if you don't understand exactly what's going on behind the scenes. So basically, as I clear my drawings, we're going to make our way in here down to around page 28, 29 in the ledger, depending on how old you are on your ledgers. But I'm going to make our way down here. In this case, it's going to be page 29. Now, when I go down to page 29, I've got a lot of things in front of us. But the first thing, again, you will notice is this monthly amount is assuming that everything was paid off day one. And we were putting in your debt service, excess cash, and your cost of insurance into this contract. Up here is the required death benefit that the IRS says, if we want to put this much money into a contract, that's how much life insurance I have to have in force to be able to do this. This client is 47 years of age. They're healthy. The first column down here, do you see the word premium? I know you do. When a bank takes out a contract like this on one of their employees, or a corporation takes out a contract like this on one of their employees, they really do look at that like it's another institution. In other words, they look at it like they run this contract like it's their daily business operation. This is $84,000 going into this contract or that bank, that location. And if I look all the way over to the right, the first thing you will notice is that $84,000 shrunk. It shrunk to $73,000 because there was overhead. A bank understands that when they take out this contract, there is a cost for the life insurance. And I promise you in a few minutes, I will go into the actual internal charges each year so that you understand every internal charge as if you lived to the age of 120. You see, it's got to be good for you. It's also got to be good for the insurance company. We put 84,000 in and we saw shrinkage. We have to overcome that cost of insurance, right? Now, to the right of it, something special. You will notice that the actual surrender value, the actual liquid cash in the contract is identical. Now, this is not the norm for people that buy life insurance from a traditional life insurance agent out in North America. 99% of the contracts that are sold and delivered in America by the biggest and largest agencies all have a thing called a surrender charge, whereas if you quit the insurance contract in the first 7 to 10 years, they will recover an abundance of the cash in the contract so that they can recover their costs. None of that is occurring here. You were given the same treatment that a bank would have gotten, that a corporation would have been given. This is white glove service treatment. In fact, one of the underwriting things that we had to go through to get this contract issued was to explain to the insurance company why, in addition to getting you through the health part of the underwriting obstacle course, why you were getting the same treatment that a Bank of America would have gotten, or a Comerica, or a US bank. This is important stuff to understand. And so we're teaching it from that perspective. Now, in the second year, you will notice we put another 84,000 in, but there's a second column here. I know that column says the word income, but for us, this will not be income. It's not an income. It is a loan. We are going to lend out every year all the excess cash. Now, we did not lend out the first year money. Why? We built a capital reserve just like a bank. But we're going to lend money at 4.6%. Now, you're going to lend the money to yourself. It does not matter to us what you spend that money on. The point is, what happened very, very, very simply is we took all the excess money and it was delivered to you as a loan. Now, the first thing you will notice, there's no payments on this loan. And there's plenty of cash in the contract to pay it off. It is fully collateralized. Now, we're not paying the interest and we're not making a payment, which means at the end of that 12 months, that loan grew by the 4.6%. And we are going to prove lending money is the most profitable thing you've ever seen in your life. But here we are in year 2. We put 84,000 in. We took all the excess cash, we lent it out. Because it's a loan, it is not income. Because it's a loan, it does not end up on your tax return as ordinary income. There is no income tax on the 73,000. Because you're the only person that you're lending this money to, it is being lent to you. We do not care what you spend the 73,000 on. It is yours to spend. Now in year 10, I'm fast forwarding forward. You have put 840,000 into this contract over a decade. In 9 years, years 2 through 10, you have lent out every dime of excess to yourself. You've gone out and you've spent 663,000. But I want you to notice to the right, those loans have grown to $836,000, almost what you put into this contract. Lending money is profitable. Now I'm going to close this contract, close what I like to refer to as your bank. And I want you to understand, to close it means you passed on. I think that this is highly unlikely because I know the statistics of a person dying. We know that if you're alive at the age of 65, the institution that you know as the CDC out of Atlanta, Georgia, the Centers of Disease Control, they specifically state if you're alive at 65, you will live 19.3 years into the future. If you and your spouse are alive at 65, one of you should make it to the age of 92. So dying at 56, highly unlikely, but let's do it anyway. We have never touched the cash in this contract. The cash has grown at about a 0.5 point larger spread than the actual money being charged on the debt. The first thing we have to do if you died is pay off the loan. We're sitting on $900,000. We pay off this note. There's $89,000 left over. We add it to the death benefit of $1,357,000, and this is a life insurance payout to your family. And because it's a life insurance payout, there is no income tax on that. You have already spent $663,000 with no tax. Your family has now spent $1,447,000. This is over $2.1 million on $840,000. Banking like a bank is extremely profitable, even in the first 10 years. With that said, because we don't feel you're going to die at this age, we need to look at an older age because we know life insurance costs more money as we get older. Is it still profitable if we live into those late 80s, early 90s? It looks great if we only live to 56, but this is not realistic. So we need to see if it's still profitable later. So we're going to scroll down to an age when you're supposed to go. And I'm going to come down this ledger. And I'm going to come all the way down to the age of 86. At this point, we have put into this contract $3,360,000. We have lent out $2,880,000, basically very darn tootin' close to $2.9 million that you have taken possession of over 39 years, every dime of excess, with the exception of the first year. That $2.8 million as a loan balance has grown and accrued to $8 million. Is lending money profitable or what? I'm going to close the bank. I'm going to assume that you passed on at 86, and that's a reasonable conclusion. At a half a point spread, we were sitting on $10.3 million of cash. We pay off the note. We had $2.3 million left over. We add that to the life insurance death benefit for a total payoff of $3,690,000. You've already taken close to 3. Now you got close to 3.7. I mean, we are talking just close to 6.7 million on 3.3 going in. Was that profitable? At a half a point? Lending money is one of the greatest things in the world. And guess what? The banks have already known that, and you're learning that tonight. But what if you lived to an age that is practically 1 billion times impossible? What if you lived all the way to the age of 120? Now, I doubt it, okay? I can't visualize it, but let's take a look and see what it looks like anyway. So here we are, 120 years of age. You see, banks have deep pockets, and it doesn't matter to them. It does not matter to them how long that person lives. And you can see right here, that's over $6 million that has gone into that contract. We have lent out for 73 years every dime of excess cash. That's almost 5.4 million. The loans have accrued to $43 million, and at a minuscule half a point spread, our cash on hand is in excess of 83 million. Now we pay off that note, and we have turned a profit of $40 million. We know we have proven to you that this contract is extremely good for you. There's nothing you can do, even at a half a point spread, that could be better than what you just saw us explain. So you sitting on a contract, there's some things you're going to have to do to make that contract work. But we want you to understand the internal cost. We want you to see that it's good for the life insurance company as well. So what I am going to do now is I'm going to clear my drawings. And I'm going to talk to you about how the insurance company makes a profit on this contract. I'm going one page past the signature pages, and I am bringing up the internal cost. I will make this a smidgen smaller so we can get the whole page on the page. And maybe you've bought term life in your life before. Maybe you bought whole life. Maybe you bought index life. If you live long enough, it does not matter what product you purchase. The insurance company will collect more money than they're going to pay out. Now, if you cancel the contract before you die, all that money that they charged up to that point ended up being pure profit for them because they didn't have to pay out a death claim. Anything they charged for life insurance might have been 20 years, 30 years. If you exit the contract before they have to pay this out, you've enriched the insurance company in the early years. If you die early, I will prove to you that they've gambled and they've lost. But I have a question for you before I get started on all of this and the internal cost. I am certain you've gone to a store in your home state. Maybe you've gone to a Costco, maybe a Sam's Club. Maybe you bought tires at a tire store. In that state, did that state charge a sales tax? Say you went into Costco and bought goods and you bought something from them. Did they add the sales tax to the bill of sale, or did the company eat that sales tax? Now, guess what? We all know the answer to that. Whenever we go buy something at a Walmart, a Costco, a Sam's Club, online at Amazon, we are hit with a sales tax. We just are. And they're not a nice guy. They don't eat it. Even though the bill goes to them, they add it to our purchase and we end up paying that sales tax. The same thing applies in the first column you're seeing here. Regardless of what state you live in, every state in this country charges a sales tax to the insurance company on premiums going in to an insurance company. It's called a premium sales tax. And you get the benefit of knowing today that whether they're taking $100 a month from you, whether it be $100,000 a month, regardless of what it is, it's about 6% for most states. The first thing the insurance company has to do is when you send money in, the insurance company has to take that money out of your pile and send it to that state. Now, all the other columns here is designed for them to collect that death benefit. Now, in the first 10 years, keep in mind, 50,000 that they collected went to the state you lived in. But 100,000 stayed in their coffers. If you died in the first 10 years, they did not make any money. If this contract is in force and all you did was give them 100 grand on $1.3 million, do not kid yourself. They lost big time. But they're not expecting you to die in the first 10 years. They're just not. If we scroll down to an age when you're supposed to pass on, which is your late 80s, early 90s, you will notice as we get older and older that by the time we got to age 91, the amount of internal charges exceeded what they pay out. And if you did live all the way to the age of 120, this was extremely profitable for the life insurance company besides you. Folks, that is 2.1 million on $1.3 million. When you add these little 5,000s here and you made $40 million profit, the insurance company ended up making $800,000. And if you quit in the first 10 years and there's no death benefit being paid out, they made 100 grand free and clear for that decade. If you stayed in 20 years and quit before a death claim it was good for them. You see, it's got to be good for you, and we've proven it's good for you. By you imitating the bank, it is good for you. By you staying to a full death claim is paid out when you're older, believe it or not, it was good for them too. And that's the only way it can work. That's why it's so important for you long-term to understand exactly what's happening behind the scenes. Folks, as you've gone through and opened this up, none of this happens without you following those two basic steps to keep your program going. And whether you came in this program 2 years ago or 1 year ago or 6 months ago, you've only got to do two key things. A, make your minimum debt payments. B, you need to understand that all excess money, every dime of it, must go into your savings. Whether that's the savings account you had before you met us at Wells Fargo, Bank of America, where you put money there and then they would lend it out, or you put it into your bank, which is your insurance contract, and you make the loans. I am certain you understand by now, if you follow through and get your debts paid off, that this is extraordinary good for you. Again, I want to thank you for your time on this portion. At this point, I am going to stop the recording, and If you have any questions whatsoever, feel free to reach out, call the number, book an appointment with us to do a review to make sure you're on track. Because this is the one thing you don't want to be messing up. You want to be on track, because the only person you can hurt by not being on track is yourself. Again, thank you, bless you. And again, thank you for being a client.